Yeah. Now coming to strategies and frameworks. So in today's call, I would be looking to share this four-factor stock selection framework of ours, wherein we look at four different factors of price trend, growth, valuation, and perception across three different settings, which is bad, good, and great. So for price trend, a bad setting is when the stock is making new lows, it is in a downtrend. Right. A good setting is when the stock has just come out of a consolidation and started making new highs. A great setting is when the stock has already been making new highs for a considerable period of time, and it is quite higher than the last consolidation that it has seen. Right. In terms of growth, a bad setting is obviously one wherein the earnings are degrowing, the margins ROC are compressing. A okay setting is when the growth is positive, margins ROC is stable, but there's a lot of room for growth to accelerate and margins and ROCs to expand. Right. A great setting for growth is when the growth is at the highest what the company is seen in the recent times. The margins and ROCs expanded in the recent times are at the very high. Right. In terms of valuation, a bad setting is one wherein the stock has seen a lot of derating and is trading at very depressed valuations. Normal setting is when basically when the stock is trading at normal valuation, not very high, not very low. A great setting is when in the recent time the stock has seen a lot of re-rating and is trading at one of the highest valuation that it has traded as over in the recent periods. The last factor is that of perception. So a bad setting in the perception is basically when there are known red flags around a specific company, right? In terms of maybe say corporate governance issue or whatever. A okay setting is when the stock doesn't have a lot of red flags. It doesn't have a lot of good green flags. It is a company which is less known and less tracked, right? And lastly, a great setting on perception is basically a company which is very well known, well tracked. It has that tag of quality and perception, right? The first setup that I want to discuss over here is setup wherein a stock has great setting in all the four factors that it has a very good price trend wherein the price trend has been there for quite some time. It is trading at all-time highs, right? Wherein the growth is at the highest, margins are at the highest, returns, ROC and everything is it's one of the highest in the recent time. The valuation has seen good rating in the recent times, trading at one of the highest valuation. And perception-wise also, it is a company that is well tracked, right? It has that following of being quality stock. Perception is very good. If a setup is such that when the stock is all those all the four factors are great, we don't want to invest in such kind of setup. And the reason is very clear that if the growth is at it's very high and the valuations also reflect that being at very high, then your upside is quite limited, right? Because everything that is good is already there, right? From here on, if the growth kind of degrows, then you can see a lot of valuation corrections, right? So that adds a lot of risk. At the same time, if the price trend has been there for quite some time, the perception is also good. That means that everyone who wants to buy and is interested in the stock is already invested, right? So that adds another kind of risk, right? So this is a kind of setup which we would like to invest in. A lot of cases, a setup wherein in a setup like this, it would kind of indicate a sell signal for a lot of stocks, right? The second setup is one wherein the stock has a bad setting in all the four factors. That is, your price is going down, your growth is the earnings are degrowing, margins are compressing, valuations are trading at a very low, depressed valuation, and the perception is also bad. Now, these are mostly turnaround bets, right? Wherein the risk reward is very high. So your risk is very high because basically you're going against the price trend, you're going against the growth trend, right? The valuations are very low and depressed, which might become a valuation trap as well. And lastly, if the perception is bad and there are known red flags, there's a risk that some of these red flags might materialize, right? So, these kind of setups, if played right, there could be a lot of upside that could be there, but at the same time, the risks are very high. For us, in some very specific situations, we would play these kind of setups, and we'll discuss more about this going ahead. The third setup is wherein the stock has okay setting across the factors, right? So your price is just coming out of consolidation, started making new highs, right? The growth is positive, right? But there's a lot of upside in terms of the growth to accelerate. the valuations are still good and has room to expand. And the perception is also good. Like it's not bad, it's not great, right? So this is a ideal setup for us because here the risk reward is very balanced, right? Because if the price is starting going higher, the growth is also positive. That means that you're not taking some extraordinary risk because you're going with the trend. At the same time, if the growth has a lot of room to expand and the valuation has a lot of room to expand, that means your upside is quite open. Okay, so this is the ideal setup according to us. So if we talk about our strategies, a stock idea list would be built on 3 strategies. The first would be our core trend following strategy, which is basically the third setup that we talked about, wherein we want stocks to have a mix of good setting across different factors, right? This strategy will basically contribute the dominant share of our stock ideas. What we would look over here is stock which is coming out of consolidation, starting making new highs, wherein the growth is positive, but it has a lot of room to expand. The margins have room to expand, the ROCs have room to expand, the growth has room to accelerate, right? The valuation is either low to medium, right? And the perception is that the stock doesn't have red flags, but it is also not a company which is very well known, right? What we don't want absolutely over here is stock wherein the price is degrowing, right? Where the growth is negative or the growth is at absolute high levels, right? Or where the perception is bad, right? The second setup is basically your strong business model with low absolute valuation. This is something that we had covered in our last newsletter. The thought process and idea over here is simple, that in a bear market, there would come situations where some of the very strong business model, just a second, right, sorry. So the idea here is clear that when in a bear market, there could exist opportunities where some of the very strong business model companies could be trading at low valuation multiple, primarily because the market overall has seen price corrections, right? And the thought over here is that if you have a business which has a strong business model, there's a very strong probability that they will continue to grow. And typically, if a company has such kind of setup where it has future potential to continue to grow, there's a decent probability that these companies will come out of any kind of drawdown consolidation. And typically, these are the companies which are the first one to recover from a bear market. In this setups, we would primarily want growth, obviously, to be okay, right? We don't want great growth. In terms of valuation, we would be looking for absolute low valuation. We don't want okay valuation, right? We want absolute low valuation. And in terms of perception, same thing. We want an okay perception, right? Third is attractive risk reward turnarounds. So these are investments like Natco that we recently bought. It's like something like Kaveri that we discussed in recent webinar, wherein it's a turnaround, wherein the setup is such that the risk reward is extremely favorable, right? But at the same time, there are a couple of things that we will need to ensure over here. First is that we would invest in such setups that are very selective and we would be very choosy, primarily because the risk in such setups could be very high, right? So the way we would look over here in this setups is that we only want to invest in opportunities where conviction and understanding is so good that we can time our entry such that the turnaround is just from the next quarter itself, right? We don't want to invest when the turnaround is say 2 quarters, 3 quarters, 4 quarters ahead, because then the risk goes up exponentially because during that time frame the stock can see a lot of correction. At the same time, in this kind of setups, we will start with a low conviction level. Firstly, to account for the fact that these are higher risk opportunities, right? At the same time, starting with the low conviction levels ensures that in the future, if the thing starts moving in our favor, we can optimize the convictions over here and capture the opportunity. So these 3 strategy over time is what will provide us with our stock idea list, right? The dominant share will obviously come from our core trend following strategy, and at the same time, the other 2 strategies will add in specific situations some of the ideas, right? Also, all this strategies and ideas would obviously be backed by a strong fundamental framework of our 6 key focus areas, which are strong business model, innovation and pivot, change and external trend, functionalities, leadership and edge, and stellar management execution. So every stock fundamentally, irrespective of the setup, would obviously need some of these factors that we have always focused on.